Swayam Prabha. Digital India. Educated India.
Welcome everyone to Real Estate Funds and Syndication. Today's topic in the course of Real Estate Finance and Investment Strategies. First, the learning objectives. So, by the end of this lecture, you will be able to differentiate between various pooled real estate investment structures, understand the mechanics of private equity real estate funds, analyze real estate syndication structures and economics, evaluate crowdfunding and fractional ownership platforms, compare risk-return profiles across different investment vehicles, and apply appropriate analytical frameworks for investment decision making. So, the evolution of real estate investment. So, from individual ownership to pooled vehicles. So, traditional approach has been the direct property ownership by individual or company. So, we have discussed this briefly earlier that there has been a traditional approach of direct real estate investment where direct buying of property is done, and that is how the investment in real estate is made. Whether it's your residential real estate or commercial real estate, that is the traditional approach. But the REIT system, which we discussed, basically gives us indirect investment option, where you can actually invest in REIT, and REIT management will basically manage different real estate under that company or scheme, and they will be managing it, and the income which will be generated will be given to you. Part of that will be given to you in the form of dividends. So, that indirect ownership model we have discussed that there is one form which is REIT. In this particular lecture, we will be discussing some other forms also, and so that is how direct and indirect we can understand. So, basically these modern pool investment structures such as REIT or the type of funds which we will be discussing in this particular lecture, they basically follow professional management and expertise, lower individual capital requirements, unlike direct investment where you have to purchase the outright full property, and here you have option of investing lower amount of money. When we were discussing REIT, we have seen that the new amendments which have taken place and has brought the REIT minimum ticket size to ticket value of a particular investment to the bare minimum share price of that REIT. So, that kind of lowering of value has taken place. So, it has now become more democratic. So, this kind of option is available in other forms also, maybe not that smaller figure, but we will see that they can also be very different from a direct investment in terms of the amount of money you want to invest. And then we have portfolio diversification benefits, because now you can decide that you have smaller amount to invest. So, you can diversify, go for more different options of indirect investments instead of just one big investment in real estate in the form of direct investment which you can make. And then there are passive investment opportunities, because here you don't have to have significant managed responsibilities which you require in a direct real estate investment, where you will be responsible for managing that building, that real estate property, but here that management aspect is taken care by the managers of these different indirect investment options which are there. Then spectrum of real estate investment vehicles. So we have different models. So we have this direct ownership, which has highest control, but the capital requirement is also very high. We can see that it is 5 to 50 plus crores, big ask, and the diversification possibilities are low because the sum required for this huge investment, generally there is less option for diversification available after that. At least we can say that about retail investor. And then liquidity is of course not that high. That market is not easily you can go and sell your property or buy a property immediately. It will take time. And then we have syndications. We will discuss what is that. Here you will see that the control is moderate. 50 lakh to 1 crore is the capital requirement. Diversification is low and liquidity is also very low. So this is there is this option. It's very similar to what you can see, but the thing which you can differentiate from here is that the capital requirement is a little lesser when we are talking about the same type of properties, and the control level is also moderate. But other than that, diversification or liquidity aspects very well match with the direct ownership. Then we have private equity funds, PE funds. Their control level is also low, and here capital requirements is 1 to 5 plus crores. Diversification is high, and limit liquidity is very low. Then we have fractional ownership, where the control level is again low, but the capital requirement is now come down from to 5 to 25 lakh, and diversification is moderate, and liquidity is low. And then REITs we have discussed earlier, which we understand because we have discussed that the control level there is very low, but capital requirement is also very, very less. Diversification potential is very high in REITs, and same goes with the liquidity also, that you have good liquidity here. You can go and sell your REIT shares in the market. Then coming to market size and growth in India. So key statistics here first. So real estate contributes approximately 10 to 15% to India's GDP. Then we have private equity investment in India in real estate, $26+ billion, which is growing. So there must be an updated bigger figure now. Then REIT market capitalization is also steadily rising, around 1 lakh crore rupees. So that is also significant. And then fractional ownership platform, there are around 50,000 plus active investors. So you can understand that even these newer investment avenues are picking up users. So you can understand that there is a lot of investment money which is waiting on sidelines, and they are looking for newer opportunities, and that is why we are seeing that these new type of investment options are now coming in Indian market. Then we have growth drivers. So we have SEBI regulations for AIF and REITs. We have RERA implementation, improving transparency. So the newer regulations by SEBI are coming for these different investment options which are now available. So your AIF and REITs are basically different new investment vehicles which have come up. So these are basically being regulated by SEBI. RERA implementation is improving the transparency. We have seen that since 2017 there has been a lot of impact of RERA, and there has been a lot of transparency because of that. And then technology enabling smaller investment participation. So as we can see that in REIT there is a very small entry level now. So these technology enabled platforms of equity or stock markets are also applicable to REIT. So that way smaller investor can also now participate in that, and even the mid-size level participant which are there in fractional ownership, they are also coming and taking part in all these different type of funds. And then there is a growing institutional investor appetite. Investor appetites are also this institutional investor appetite is also growing, because now they have option of more transparent vehicles, real estate related vehicles, investment vehicles, where they can invest or park their money. So that area is also opening up. Then we have private equity real estate fund. So here first we will talk about the definition aspect of this. So we have first a very basic definition which is important to understand. These are pooled investment vehicles that raise capital from multiple investors to acquire, manage and eventually dispose of real estate assets according to predetermined strategy. The key word here is predetermined. Investors commit capital without knowing exactly which properties will be purchased, hence the term blind pool structure. So the key characteristics define how these vehicles operate. They use committed capital. Investors promise to provide money when called upon. They have professional management teams with institutional experience and resources. The investment horizon are typically 5 to 10 years, which allows for value creation through active management. They follow a diversified portfolio approach rather than betting on a single asset, and they focus on institutional quality assets and processes. So the kind of properties and management standards that basically institutions would expect. Then we have private equity fund structure. So understanding the regulatory structure is crucial for anyone considering these investment. In India, most real estate funds operate as SEBI category 2 AIF. This classification brings specific requirements and investor protection. So the minimum corpus here is 20 crores. This particular thing ensures that funds have sufficient scale to operate effectively. The maximum of 1,000 investor per fund maintains the private placement nature while allowing reasonable diversification of the investor base. The minimum investment of 1 crore per investor ensures these remains targeted at high net worth individuals and institutions. The key participants creates a check and balance system. So the general partner is the fund manager and sponsor. They make day-to-day decisions and are responsible for performance. The limited partners are passive investors who provide capital but don't make operational decisions. The investment committee makes acquisition and disposal decisions, often including independent members, and the advisory board provides LP oversight and ensures GP accountability. The structure aligns interest while providing professional management and investor protection. Then we have fund economic terms. Here we will see the alignment of interest. So management fees typically range from 1.5 to 2.5% of committed capital during the investment period when the fund is actively acquiring properties. This reduces to 1 to 2% of invested capital during the holding period when properties are being managed. These fees cover the operational expenses of the fund managers, salaries, office cost, due diligence expenses, etc. Then we have carried interest or promoter is typically 20% of profit after preferred returns. After investor basically have received their preferred returns. The preferred return is usually 8 to 12% annually. This means investors get their target return first, and only after that does the fund manager participate in profits. So this creates strong incentives for outperformance. Now let's look at the example. A 100 crore fund generates 15% gross IRR. Management fees total 2 crores annually. Investor receive 8% preferred return first. The fund manager gets 20% of profit above the preferred return. So their structure ensures that fund managers only do well when investors do well. Then coming to investment strategies by risk profile. So we have seen these strategies, but this time we will be looking at them through the fund discussion which we are having. So different fund targets different risk profile based on their investment strategies. So the risk spectrum is crucial for investors to understand. Core strategies target low risk, stable assets. You can think fully leased office buildings in prime location with high quality tenants. Target return would be 8 to 12% with most return coming from income rather than appreciation. So Blackstone Embassy portfolio is a perfect example, acquiring stabilized office buildings with strong tenant profile. Then we have core plus strategies, add moderate risk for enhanced return of 10 to 14%. These might involve properties that need minor improvements or have some lease expiration risk. So GIC Singapore's investment in India often falls in this category. Then we have value add, which target around 14 to 18% return by taking moderate risk through repositioning opportunities. This might involve renovating properties, changing use, or improving operations. Kotak Realty Fund specializes in these situations. Then we have opportunistic strategies that target high return of 18% plus by taking on the significant risk through development projects or distressed assets. So HDFC Capital Development Funds exemplify this approach. So understanding this spectrum help investor match their risk tolerance with the appropriate fund strategy. So as per your target IRR and the risk taking capability, you can decide on the fund you want to go with. So if you are risk averse, low, you want to take low risk, then in that case you can go for these type of portfolios. And if you are ready to take high risk, you can go for these type of funds. So basically that is how you can select the appropriate fund for your investment. Then we have major players in Indian market. So Indian real estate fund market include both global and sophisticated domestic players. International funds bring global expertise and significant capital. So Blackstone has become the largest owner of office space in India through strategic acquisition and partnership. Brookfield focuses on core commercial assets with their partial capital approach. GIC and CPPIB represents the sovereign wealth funds with long-term investment horizon, perfectly suited for the real estate. Then we have domestic fund managers such as Kotak Realty Fund, specializes in special situations and value-add opportunities. We have HDFC Capital, focusing on development and affordable housing projects. And we have Ask Property Investment Advisors, targeting value-add strategies across different property types. Here we can talk about the recent trends. So, recent trends show important market evolution. There has been a shift from residential to commercial focus, as commercial properties often offer more predictable cash flows. We are seeing platform deals rather than single asset investment. Funds are partnering with developers to create pipelines of opportunity, and many funds are planning REIT formation as exit strategies, creating liquidity for their investor while maintaining the management control. Then we have single asset investment vehicle, real estate syndications. So, syndications are partnership between sponsor and multiple investors to acquire and manage specific properties. The key word here is specific, right? It is specific properties. Unlike funds where you don't know exactly what will be purchased, syndications are formed around identified properties with defined business plans. The key differentiation from funds are important to understand. Syndications have single asset or small portfolio focus rather than the diversified portfolio. They come with property specific business plans. You know exactly what the sponsor intends to do with the property. They typically have shorter investment horizon of 3 to 7 years. Investors get direct ownership in the specific property rather than the units in a fund. However, they often require higher minimum investment relative to the property value, right? So, this structure appeals to investors who want to understand exactly what they are investing in and prefer transparency over diversification, right? Then in India, syndication can use several legal structures such as limited liability partnership structure are tax transparent. We have profit and losses flow through to partner personal tax return. They offer operational flexibility in management and profit sharing arrangement. Then we have private limited company, which the structures provide strong governance framework with clear board oversight and decision making processes. However, they face corporate taxation, which can create double taxation on distribution. Then we have trust structure, often customized distribution mechanism, and are often preferred for family oriented investments where multiple generation might be involved. Then we have economic terms here. So, typically include an acquisition fee of 1 to 3% of the purchase price paid to the sponsor for sourcing and closing the deal. We have asset management fees of 1 to 2% of annual cover ongoing property management and the reporting. And then the promote structure, typically 20 to 30% of profit above a preferred return, aligns sponsor interest with investor, and then sponsor co-investment of 5 to 20% ensures the sponsor has skin in the game. So that is how the structure is followed. Now let's walk through a detailed example to understand how syndication economics work in practice. So we have a 50 crore office building investment with 20 crores equity requirement, 40% of purchase price basically, and the sponsor contribution is 3 crores, 15% of the equity, while investor contribution is 17 crores, 85% of the equity. Distribution waterfall creates a hierarchy of returns. So return of capital 100% to all investor pro rata until they receive their initial investment back. We have preferred returns 8% annually to all investors on their outstanding capital, then catch up 70 to 30 split until sponsor achieves overall 20% profit share, and then final split of 80-20 on all remaining profit. So the structure targets 15 to 20% IRR to investors over a 5-year period. The waterfall ensures investors get their capital back plus preferred returns before the sponsor participates meaningfully in profits. So while still providing significant upside potential for successful execution. Then we have syndication process timeline. So understanding the syndication timeline helps investor appreciate the complexity and coordination required. So phase 1 is deal sourcing and underwriting, which is around 2 to 4 weeks, involves property identification through broker network or direct relationship. Preliminary analysis include financial modeling and market research. Initial purchase negotiations, establish the basic terms and conditions, and then financial modeling and business plan development creates the investment thesis and return projection. Then we go to phase 2, which is capital formation for 4-8 weeks, which includes due diligence execution, physical, financial, legal and environmental analysis, investor presentation, and capital raising involves marketing the opportunity to potential investors. And the third one will be legal documentation and debt arrangement, finalizing the structure and financing. And the third phase is your execution, which may be for 3 to 7 years, covers property acquisition and closing, business plan implementation. So basically through renovation, leasing or operational improvements, then regular operations and investor reporting, maintains transparency and track performance, and exit preparation and property sale, maximizing return through strategic timing and marketing. So this process requires significant expertise and capital coordination, explaining why successful sponsor meaningfully promote structures, right? Then we have crowdfunding and fractional ownership, basically a technology enabled investment access. Now we enter the newest and most innovative segment of real estate investment, which is crowdfunding and fractional ownership platforms. So these are digital platforms that enable investors, multiple investors to collectively invest in real estate properties through fractional ownership structures. The fractional aspect means you are buying a small percentage of larger property rather than owning an entire asset. The key characteristic represent a paradigm shift in real estate investment. Accessibility. We have lower investment, minimum investment of 5 to 25 lakhs makes institutional quality properties accessible to much broader investor base. The technology enabled investments and reporting streamlines the entire process from discovery to ongoing management. There is a focus on institutional quality commercial properties, and then grade A office buildings, premium retail logistic facilities will be such type of buildings. We have then streamlined documentation and processes that reduce the complexity traditionally associated with real estate investments. However, there is a growing regulatory attention and framework development as these platforms scale and mature. So, for fractional ownership, it was something that we discussed earlier, that there is a new form of REIT, which is SME REIT. So, mainline REIT, we understand that the minimum capital requirement is 500 crore, like they should be of 500 crore plus size. But recently, the SEBI has brought in 50 to 500 crore, a new segment of SM REIT, which is your small and micro REIT. So, basically, these type of REITs are, this particular regulation for SM REIT came in because the SEBI first floated a proposal discussion basically to everyone. They asked people's advice that what they think about certain provisions they made for the SM REIT, because they were thinking of bringing fractional ownership platform into the ambit of regulation. Because earlier, when the fractional ownership platform came in India, there was not much rules and regulation for them. So, the idea was that there should be regulations for fractional ownership also, because that will then safeguard the investors who are lining up to invest in them. So, that is how this SM REIT basically was brought in. These regulations were brought in by SEBI. So, as we are discussing right now, more and more such regulations are being developed for these new investment vehicles, because earlier there was no need, because they were not there in India, but now as they are coming up, so SEBI is also active and looking for safeguarding the investor interest. So, then we have fractional ownership models. So, we have equity fractional ownership, which provide direct ownership stakes in commercial properties. We have investors receive rental income distribution plus potential appreciation when properties are sold. We have typically holding period of 5 to 7 years, similar to traditional real estate cycles, and examples include strata, edge bids, property share platforms that have gained significant traction in the Indian market. We have debt crowdfunding, which offers fixed return investment secured by real estate collateral. So, returns typically range from 12 to 18% annually, with short term of 1 to 3 years. This represents a lower risk profile than equity investment, since debt holders have priority in case of problems. Example would include Grip Invest, and Lend and Club. So there are these new platforms. And then we have club deals, which require higher minimum investment of 50 lakhs or more, but involves smaller investor group of 10 to 50 participants. These follow a more institutional approach to property selection and management, bridging the gap between syndication and broader crowdfunding platforms. Then we have major platforms and the performance. So let's examine the leading platform and their track records to understand this market's maturity. So we have Strata, founded in 2019, focusing on commercial properties with 25 lakh minimum investment. Their target 8 to 10% yield plus appreciation, and have built around 900 crores. Now this is a snapshot. The minimum investment, typical returns, or asset under management, all these things are continuously evolving. So this might be different by the time you see this. So you please note that this is just for the information purpose, the understanding that these type of platforms are there, and this is the kind of performance they are expecting. So it might be higher, it might be lower, and it's no way in any way fixed. It is completely dependent on them, and moreover this is just a snapshot of these type of options which are available in India. There can be more such platforms, and moreover more and more platforms are coming up. This is a continuously growing area. It's not just that these few companies are there. More and more platforms will be available, and as the market grows you will see that that is the case. So in no way this is the final numbers. You can say that this is just a glimpse of what the they might be offering, and this is a typical range which might be different for different periods. So this is the basically the snapshot of say for example Strata. We said the Strata that commercial properties are there. Then Edge Bits is looking at premium office properties. Property Share would be looking at grade A commercial, and Asset Monk is looking for different growth opportunities. And then minimum investment also, you can see that at least 10 lakh is something which is required by all of them, and that is the case with SM REIT also, that currently SEBI, even though they have brought SM REITs to basically not replace, you can say that basically they have tried to bring in this new system so that this fractional ownership platform can become standardized. So there also the minimum investment for investor is 10 lakhs. So you might be remembering that I said that in REIT we have minimum investment of rupees 10 to 15,000, which is for IPO, and for your normal secondary market purchase it is the normal share which you can buy, any one particular share for that exact price for which it is quoting. But for SM REIT it is different. For SM REIT it is that minimum investment which an investor can make is 10 lakhs. So they cannot make anything less than 10 lakh. Maybe in few years it will go down, because initially when REITs were brought in, that time also the initial investment minimum investment price was high, but then it was brought down to just at equity level. So maybe in future SM REIT also it will develop like that. But currently you can see that whether it is for your fractional ownership platforms or for your SM REIT, it is minimum 10 lakh rupees. Then we go to regulatory environment and challenges. So this is there is a evolving framework for crowdfunding. So no specific regulation for real estate crowdfunding. Crowdfunding is still developing. We are still looking at this. So maybe soon you will see that there might be new regulations for that also. So current status shows no specific regulation for this. They operate under existing company LLP structures, which create some regulatory uncertainty. So SEBI is exploring we have seen SM REIT regulations, and they have brought in for LLPs for the fractional ownership. They have already done that. So key regulations include the key regulatory considerations would be to securities law applicability, whether fractional interest constitutes security requiring registration, that will be the question. Then collective investment scheme regulation may apply to pool structures. Investor protection and disclosure requirements need clarification for retail investors, and secondary market development and oversight remains unclear. So these are some areas which are evolving, and like we said that SM REIT are now there, and as these regulations are coming, they are making this area more and more transparent and safer. So that is the response from regulators. Then the industry response has been proactive. Platforms are pursuing self-regulation through industry associations to establish best practices. They are implementing voluntary transparency and disclosure standards, often exceeding current requirements. Most importantly, they are engaging in active dialogue with regulators on framework development to ensure appropriate oversight without stifling the innovation. So the regulatory evolution will be critical for long-term market development and investor confidence. So that is how the regulatory environment and challenges will evolve. And then we have a basic comparative analysis here. So we can see that for PE real estate funds, you have moderate to high risk level, target of 12 to 20%. We have real estate syndication of 15 to 25%. Risk level will be considered moderate to high. And then fractional ownership, risk level will be low to moderate, and REIT low to moderate. Now because we understand all of them, we have we have seen what are they. So you can relate with this table. And then we have cash yield, which is strategy dependent for PE real estate, but real estate syndication it would be around 8 to 12%. Fractional ownership it will be 7 to 9%, and REIT it will be around 6 to 8%. We have holding periods. So PE real estate funds, because you are basically investing to basically in a specific property, targeted property. So the holding period will be longer, 7 to 10 years. For real estate syndication, it is 3 to 7 years. For PE real estate funds, it will be not exactly what you basically depend on the PE real estate funds to decide on which property they want to invest. For real estate syndication, you are exactly clear that in which property you are investing. So that is how the strategy would be, and the holding period will also depend on that. And then fractional ownership, we have of 3 to 7 years of fractional ownership term for investment at least. And REIT is indefinite. It depends on what kind of investor you are, whether you are a short-term investor, long-term investor. So you will decide on your own that how long you want to stay in REIT. And the liquidity, of course, in REIT, it's just like any other stock market share. So very high. Fractional ownership, it is limited. And other two cases of PE real estate fund and syndication, it is very limited, because there is very difficult to find a secondary buyer for the share or the rights which you have currently with you. So that kind of arrangement will be there in the liquidity. So accessibility pyramid. So we have ultra high net worth, which is 5+ crore. So they have option of private equity funds, large syndication, estimated around 1,000 to 2,000 active investors in India for this particular type of funds. Then we have high net worth individuals. So for that 50 lakhs to 5 crores. So they may go for syndication, smaller funds, fractional ownership. They may also go for REIT because when you have a big portfolio, you want to diversify, and REIT you can increase the amount. It is just like equity. You can buy as many as possible. So basically that they can also do. But if we say that the qualifier, whether they can qualify for it, so of course high net worth individual can qualify for syndication, smaller funds, fractional ownership. But generally PE funds are way beyond even 5 crore, so they might not be accessible to them. But for higher middle class or affluent individuals, so around 5 to 50 lakhs, fractional ownership platform REITs are open, and estimated 50,000 plus, as we have discussed earlier, that there is a fractional ownership platform members, and they are rapidly growing. And for REITs, it's just like stock market, so you can understand that there will be a relatively higher number of investors, retail investors in REIT. And coming to geographical distribution, so traditional vehicles, they are concentrated in major metros, and digital platforms, we have broader geographical reach across India. So if we are talking about a normal buying, or specifically going for certain specific type of arrangements, then in that case you have concentration in specific cities, while in digital platforms you can say that anyone from anywhere can invest in a fractional ownership platform, or they can invest in REIT. So more and more people can access them through digital platforms. Then fee impact analysis. So the total cost of investment, we have to understand this. So we have discussed this briefly, that in private equity funds, the management fees is 2% annually, carried interest is 20% of profit, so that there is a skin in the game of the management team of whether it is PE fund or whether it is syndication. So there will always be some profit sharing kind of arrangement, so that it reflects that the management or the sponsors are also there, because they have a certain amount of investment, minimum investment they have to make, or that they will also be a part of the the profit which will be generated. So they will be motivated to earn more and more profit for the that particular fund or syndication. So in syndication, we can say that acquisition fee 1.5%, asset management 1% annually, and promote basically 20 to 30% of profit. And so the total impact would be 2 to 4% reduction in the gross return, while in PE it was 3 to 5% reduction in the gross return. So basically this amount is going directly as fees to management or some other works which are there, and so that is what is the percentage that will be cut from your gross return, and then you can understand that remaining will be there for you as investors. And then we have fractional ownership platforms. So platform fees is 1 to 2%, management fee is 1% annually, and performance fee is 10 to 20% of excess returns. So total impact will somewhere around 2 to 3% reduction in the gross return. So in all the three, you can clearly see that there is a management fee, and that you can estimate that it will be coming out from the profit, and it will be given to the management for doing their work. Then we have due diligence considerations. So we have key factors for investment evaluation: manager sponsor asset assessment, so track record across market cycles, how they have been in this area, how they have performed in past. Team stability and experience, their experience in this area, how stable this team would be, how longer they will be working, and all that. And then investment process and discipline, so what kind of investment strategy, what how they follow that, and whether they have been disciplined in their investment or not in past. And the alignment of interest investment through co-investment, so your view and their view matches, then only you can think of going with them, because we have seen that there can be strategies like core plus value, So also whether you are going for strategic investment, so that all this will play out. That is your view towards the market and that of these managers matches. So that kind of you will have to see. And then we have investment specific factors. So property which we are looking to invest, what is the quality, location and tenant profile, market fundamentals and growth prospects of that, the business plan feasibility and the execution risk. So that also you will keep an eye on. And then after the investment has been done, how the exit will be done. So exit strategy, clarity and the market conditions, all this will have to be looked into. So all this will become important factors. Exit strategy, clarity, we understand that how a particular investment will be finally exited, whether it will be you will continuously owning it, or there will be a future sellout of the property to some other party, or maybe the REIT option, which is also being explored now by many developers. To transfer your assets into the REIT and ultimately getting the money through that channel. So that is also being looked into. So there are different type of these options which you have to understand. And then structural consideration will be legal structure and investor protection. In what form this company is formed, how your how your investment is protected, and then what is the fee arrangements and their impact on the return. Hopefully the fee is not very high, otherwise it will diminish your return. And then what are the government mechanism and decision rights. So basically, in case there is any issue, how the decision hierarchy will take place, and the liquidity options and holding period flexibility. So if you want to sell your stake, how easily you can do that, and for how long you will have to keep your stakes in that particular venture. Then post-COVID market evolution. So we have office sector, hybrid work model creating space optimization needs. So we have seen that hybrid work model is creating space optimization need. Industrial, we have seen that e-commerce is driving institutional investment growth in this sector. Retail focus is on experimental and omni-channel strategies because of the online increasing a lot. And then residential, there is a consolidation favoring established developers because of the RERA. There has been this change. And then we have technology integration. So AI and data analytics in investment decision making is now coming up. Digital platforms expanding investor access. So we have seen that fractional ownership now have more than 50,000 investors in it. Blockchain application for ownership and transaction is making the process much more safer for investors. And we have prop tech integration in the asset management, and that is also bringing lot of benefits to this sector. And then we have regulatory developments. We have formal framework for crowdfunding platforms for the platform like fractional ownership. So we have seen that SM REIT rules have come in, and enhanced disclosure and investor protection measures are there. More and more investor protection measures are brought in by SEBI. And then secondary market development initiatives are also taking place, that you can after you have done all this primary investment, you can then sell your stake. So that kind of secondary market development also is now coming up, so that there is option of exit, more option of exit for the investors. Then strategic portfolio allocation. So we have earlier in previous class, we have discussed that we can go for core holding, we can go for satellite holding, that is basically a combination core or satellite type of, where you have a mix of aggressive and stable, and you have aggressive kind of allocation. So this kind of diversified real estate allocation can be one of the option. So you can look for the funds which are doing this. So value add funds and syndication for this, fractional ownership for property specific opportunities. So basically a combination of REITs for value add funds, fractional ownerships, and all this you can do and make a portfolio out of it. Then we go to case study summary. So Blackstone India basically is a success here. Entered market during capital scarcity during 2011 to 2014. They build scale through platform partnership with quality developers, active asset management and operational improvements they brought, innovative exit through REIT formation. So they exited REIT. They brought investment into Embassy REIT and then exited in the REIT, and that is what they did. So their timing, invested during the attractive valuation environment, built meaningful portfolio enabling operational efficiency, and then partner selection, worked with established institutional quality developers, value creation, enhanced the properties through renovation and management, and exit innovation through pioneered REIT exit strategies in Indian market. And result was that portfolio appreciation of 2 to 2.5 times over 5 to 8 years through combination of income and capital appreciation. So this is one of the success story in this area. Here you can see that 100 crore property investment, purchase price 100 crore, debt is 60 crore, total equity 40 crore, sponsor equity, and then 5-year exit at 150 crore. So debt repayment, net proceeds were 90 crore, and distribution calculation of ROC of 40 crores to all investors, 2.8% preferred return, that is 16 crore, 5 years into 8% into 40 crores. So that kind of return we got, and then remaining 34 crores, 70 to 30 split, and that is how these type of syndications will actually distribute their money. So risk management framework, fund level risk, manager risk, blind pool risk, liquidity risk. So that is there. Manager, how well they are. Sometimes you don't know where the investment will be done. Liquidity, whether you can come out of the the investment or not. And then market risk, tenant risk. These are property related, normal commercial market related risk. And of course leverage, exits risk, and regulatory risk is always there with any property. So future outlook here. So in next to 5-year expectation, market will continuously institutionalize. There will be lot of retail participation here and enhanced transparency. Product will be continuously evolve. More and more products will improve, and ESG focus will be seen here. And regulatory also will evolve along with the new investment vehicles are coming up. So SEBI is also bringing their white papers to discuss with the industry and the stakeholders, and continuously evolving the policies for this area. So in summary, we have to be very clear about the manager selection. Due diligence has to be done. Portfolio has to be constructed keeping in mind our overall strategy, and we should be aware of the fee which they are charging. What is the liquidity, how we will be able to sell, that we should be clear of. And future preparation, understanding the structure positions investors to benefit from India's real estate market evolution. So this is how the overall discussion you can summarize, and hopefully you have gained from this session. Thank you so much.